Hello and welcome. Inheritance tax in the UK is facing a massive shakeup in 2025, and lifetime trusts are right in the middle of all the changes. To help make sense of it all, we're going through this fantastic breakdown from the experts at My Tax Accountant.
A bowl of spaghetti. That sounds about right, doesn't it? If you've ever looked at these rules and just felt totally lost, trust me, you are not the only one. So our goal today is to untangle all of this, one piece at a time. So here's our roadmap. First, we'll look at the big tax that gets this whole conversation started. Then, the tool people use to manage it, lifetime trusts. After that, the huge rule change coming in 2025, some of the hidden costs you need to know about, and finally, a checklist to get you prepared.
Okay, it really all begins with one single number, and it's this number that makes estate planning so incredibly important.
40%. Just let that sink in for a second. For every pound over the threshold, 40 pence could go straight to the taxman instead of your loved ones. That one figure is precisely why things like lifetime trusts were created in the first place.
So what do you do about that 40%? Well, for a long time, one of the most powerful tools in the estate planning kit has been the lifetime trust. Let's take a quick look at exactly how it works.
The easiest way to think of it is like a secure box. You, the settler, place your assets inside this box while you're still alive, so legally they aren't yours anymore. You get to set the rules for who gets what and when, and because it's taken out of your estate, it can seriously shrink that final tax bill.
But, and this is a big but, how you give that money away makes a huge difference. Giving a gift directly to another person, that's usually fine as long as you live for 7 more years. But putting that same gift into most types of trust is a whole different ballgame. It can actually trigger an immediate 20% tax charge, right there on the spot. It's an absolutely critical difference to understand.
Right. But here's the real game changer. This is where the ground is literally shifting under our feet. From April 2025, the very foundation of these rules is being ripped up and replaced, and I think it's going to catch a lot of people by surprise.
So here's the change in a nutshell. It used to be all about your domicile, which is this sort of vague, complicated idea of your permanent home. Now, it's just simple math. If you've been living in the UK for 10 years, boom, the taxman can now look at all of your assets, no matter where they are in the world. This is a massive shift for anyone who has been a long-term UK resident. And believe me, this isn't just theory. Just imagine someone like Mrs. White. She set up a trust years ago for her overseas properties, thinking they were completely safe from UK tax. But because she's lived in London for over a decade, these new 2025 rules suddenly drag all that property into the UK tax net. A plan that was absolutely perfect a year ago could now trigger a massive, unexpected tax bill. And the tax doesn't just happen once. Oh no. Once a trust is up and running, it actually comes with its own schedule of tax obligations that the trustees have to be prepared for. There's a number that every single trustee needs to have circled on their calendar. 10. Because every 10 years, something big happens that can trigger a whole new tax charge. It's called the 10-year anniversary charge. Basically, HMRC revalues the trust and can send a bill for up to 6% of its value. This is a huge trap, especially for trusts that hold assets like property. Because you have to ask, how do you pay a cash tax bill on a house without being forced to sell it? Now, this brings us to a really common question, and honestly, a massive potential pitfall. What happens if you put an asset into a trust, but, well, you carry on using it? This is one of those areas where the rule is brutally simple. You just can't have your cake and eat it too. If you put your house in a trust, but you keep living there rent-free, HMRC just pretends the gift never happened. For tax purposes, that house is still 100% part of your estate. To get the tax benefit, you have to make a clean break. So, with all these changes and pitfalls looming, what can you actually do right now to get ahead of the curve before that 2025 deadline arrives? Okay, this is your action plan. It's really about getting your ducks in a row. You need to know exactly what kind of trust you have, where you stand with these new residency rules, and what assets are in there. This whole process lets you spot any potential problems, like an upcoming 10-year charge or one of those gift with reservation issues, before they turn into expensive headaches. And that really is the key takeaway from all of this. A strategy that was watertight in 2024 could be full of holes by 2025. That's why reviewing your entire setup isn't just a good idea, it is absolutely essential. The biggest mistake you could make right now is to just assume that nothing has changed for you.
Look, it's clear this can get very complicated very quickly, and the cost of getting it wrong is high. For advice that's tailored to your specific circumstances, you really should speak to a professional. The team at My Tax Accountant are ready to guide you through it. You can reach them on WhatsApp or by phone at 07854 255 375, or you can drop them an email. And please don't forget to subscribe to their YouTube channel to stay on top of all the latest updates.